What up, Crypto Warriors and Sergeant Crypto back at it again. Today is Tuesday, March 17th, 2020. If the American people allow private banks to control the issuance of their currency, first by inflation and then by deflation, the banks and corporations that will grow up around them will deprive the people of all their property until their children will wake up homeless. Thomas Jefferson, third president of the United States. Talking about central banks. Let's get into it. So the world is kind of having a little moment right now. So because I don't want to get flagged from YouTube, I'm going to talk about that little moment as the boo-boo. It's like I'm talking to my 6-year-old son. All right. So the boo-boo happened, and it started in China. We know what's happening in the world right now. Everyone's being quarantined and asked to stay away from large crowds or just to stay out of the public, stay at home as much as possible. And we even have the public schools here in New York City shutting down, and starting tonight as a matter of fact, restaurants in New York City are going to shut down as well. The boo-boo happened. The boo-boo isn't the cause for all of the things that's happening in the world of finance, although that's what they may try to spin it as. So this is why I'm here, to give you guys the real. Let's get into it. But first, I have to give you a little backstory on what kind of led us here. So here it is. I'm going to go to TradingView. As always, everything's going to be linked in the description below, all the articles and images I use. So I have certain key points on the S&P 500 highlighted here on TradingView. And this is what took place last week. We had a market high of 3,400 for the S&P, and in just 28 days, it dropped 30%. The other views I have here, or the other highlighted sections I have here, as you can see, according to the dates here, is the dot-com bubble, or, the year 2000, dot-com bubble, and also the housing bubble, the Great Recession from 2008. As you can see, it took from the peak of about 1,500 for the S&P here in 2000 for it to lose half its value. It took about 944 days. So what's that? Like 2 years, basically, right? Or a little over 2 years actually, for it to lose a full 50% from the peak. So from 2000 to 2002, during the the housing bubble, the peak was again about 1,500, and it lost about 50% of its value again. All right, and this time it took a year and a half, 545 days. Well, we already lost 30% in less than a month. In about 3 weeks, we lost, well, actually 4 weeks, because 28 days, right? So in 4 weeks, we lost a full 30% from the market, peaking at around 3,400 at the top and going all the way down. We lost, shaved 1,000 points off, and we are below or at 2386 as of this recording right here. All right, so there you have it. They're going to try to blame it on the boo-boo. As a matter of fact, they've been blaming it on the boo-boo, but these things have been happening since 2008. A lot of the problems just carried over from 2008, and we've just been on this massive bull run since 2009, and people should have expected a correction, right? Nothing goes up and lasts forever. It has to come back down. What goes up must come down. It's just logic. All right, so here it is. So first, coming from Bloomberg, talking about the repo markets. So I'm just going to read the first paragraph here, and then we're going to get into it. When plumbing works well, you don't need to think about it. That's usually the case with a vital but obscure part of the financial system known as the repo market, where vast amounts of cash and collateral are swapped every day. And it's just giving you a quick little background. So what is a repo? It's where piles of cash and pools of security meets, resulting in more than $3 trillion in debt being financed each day. Repo is short for repurchase agreements, transactions that amount to collateralize short-term loans often made overnight. All right, quick little history gave you. And how's the Fed involved? In a number of ways, for years, central banks around the globe have used their own repo markets to temporarily extend credit in tight markets. So they manipulate the system, stabilize financing costs, and guide interest rates. Many things have changed in the repo market since it melted down in September 2008. So things have changed. A crucial part of that year's financial panic. Since then, the Fed has worked with other regulators to curb risk taken and bolster liquidity requirements as a way of preventing a recurrence. And since 2013, the Fed has entered the repo market on a large scale, using transactions there to put a floor under the rates. So basically supporting the system. All right, so what happened? In the week of September 16th, all right, there was a mismatch. So a lot of cash flowed out of the repo pipes just as more securities were flowing in, meaning that suddenly there wasn't enough cash for those who needed it. This mismatch drove overnight repo rates to 10% on September 17 from about 2% the week before. So basically, one bank wanted to borrow money, and typically when the banks loan money to each other, they would just charge them about the 2%, which was the Federal Reserve rate at the current time. Well, if Bank A doesn't trust Bank B to be able to pay back their loans, they're going to charge a higher interest rate. That's, it's just like having a credit score, correct? So there it is. A bank didn't trust another bank, and they raised the rates on them, and that caused a hiccup in the system, so to speak. Well, the system's been bursting at the seams, and there have been cracks and things of that nature happening, right? And it's not because of the boo-boo why these things are happening. Is basically what I'm saying. So what did the Fed do? In its first direct injection of cash to the banking sector since the financial crisis, it laid out as much as $75 billion a day in a temporary cash over into temporary cash over 4 days to quell the funding crunch and push the effective Fed funds rate down. Because when Bank A didn't trust Bank B, gave that 10% rate, it pushed up the Fed's rate from 2.25% to 2.3%, and that caused a hiccup throughout the whole system. All right, even though it was just only a 0.5% point, it was putting pressure on the pipes, so to speak. And there it is, scrolling down. What does that mean? So it could mean that, oh, I'm sorry, I skipped like a whole section here. So they're only supposed to be pumping pumping $75 billion for 4 days into the system to help it out. 4 days. Remember that number, 4 days. Well, they didn't stop after the 4th day. They just kept going because a lot of banks are in trouble. A lot of banks don't have the money. They don't have the money. They're too much in debt. So the Federal Reserve has just been pumping money into the system to keep it alive. And when I say pumping money into the system, it just means printing off the money. And here we go. So what does that mean? It could mean that bank reserves, which top $1 trillion, still don't amount to having enough money in the system. The Fed has been buying $60 billion of treasury bills per month and has said that they will continue at least into the second quarter of 2020. We are currently in the first quarter right now. So since September, they've been pumping $60 billion a month, and that's not including the first $75 billion, which they gave over the first 4 days. So since October, November, December, January, February, and now we're in March. All right, so that's $60 billion over 6 months. So that's $420 billion. And they said that they would continue doing that into the second quarter, which is another 3 months from um, April to till June. So that's another 120, right? I can't do the math off the top of my head. Boom, 420 plus another 120, boom, 540. So basically $500 billion they were planning on pumping into the markets. Well, no one expected the boo-boo to happen. No one. And once the boo-boo happened, it wasn't the cause for this financial crisis. It was just the needle that popped the bubble. All right. It was the last straw. It was just, when they say, why did it take one straw to break the camel's back? Because there was like hundreds of billions of dollars or other straws on its back already. It couldn't hold up anything else. Scrolling down some more. No, that's it. That's all I highlighted. The Federal Reserve is going to be pumping or has been pumping money into the system since September, and they weren't planning to stop. So last week, with that big hiccup that happened when the market took basically a 30% shave off the top, they cut interest rates down a half a percentage point or a half a basis point, and that wasn't enough. It allowed for a quick 10% gain back, but as we saw on Sunday, March 15th, the Federal Reserve Chairman came out and said that he's going to cut rates again, and he did. He cut rates by 1%, cut rates all the way down to zero. They have not done this since 2008. They have not done this since 2008 when they cut rates down to zero. Well, back then they had more to play with. They had more room to play with. Interest rates were at about 5-6% back then, and they were able to cut it down all the way down to zero. And it stimulated the economy enough to have us go on this continuous bull run all the way till today. Well, now he's cutting rates again. And mind you, nobody has said the big R word yet. No one has said that we are in a recession. They don't typically say that we are in a recession until 6 months to a year down the road, and they'll finally admit that, oh yeah, the recession started 6 months ago, or whatever the case is. Well, they're not saying it, right? All they're saying is, oh yeah, we're going to stimulate and we're going to provide liquidity, which means print more money, and help the system out. They're not helping you or myself out. They're helping the quote unquote system out. They're helping the system out by printing more money to give it to these big, large corporations, right? And cutting interest rates down to zero, which means free money. So when a company or a large corporation wants to borrow money to buy back their stock, right? Because that's all they do. They're not doing it to do R&D or hire more people. They're just doing it to buy back their stock. They're able to get it at a 0% interest rate. They're able to get this free money, basically. So the Federal Reserve on Sunday slashed its main interest rates to near zero in an emergency move. It's part of a broader government effort to ease the economic effects of the boo-boo pandemic. Like I said, I don't want to say this word right here because I don't want to get a strike from YouTube. Well, that's not the cause. Like I said, it was the final straw on the camel's back. It was the needle that popped the bubble. This isn't the cause. The cause is this going back to the repo markets, overnight repo markets, and these banks being insolvent, not having the cash, not having the liquidity, the funds to purchase these debts, to purchase these securities. Somebody out there has a big problem. And if you watch like YouTube channel like RT with Max, the Kaiser report, Max Kaiser and Stacey Hubbard, all the fingers are basically pointing to Deutsche Bank. So, Deutsche Bank is Germany's oldest bank and Germany's largest bank, and they're basically holding up all of Germany, and Germany is basically holding up all of the Eurozone. They're the only ones that produce anything. So if that bank goes, that's an even bigger problem. Not if, when that bank goes, because it's going to happen. These things are going to happen. So there you have it. We have the Federal Reserve coming out saying that they're going to, not saying, they already cut rates. This is as of Sunday, the 15th of March, 2 days ago, they cut rates down to zero. We have no room to play with. So right now, rates are at zero, which means that, hey, if you have good credit or if you have a business with cash flow, you could borrow a lot of money and basically put it into real assets, that also provides cash flow. So if you were, looking to get into real estate or whatever like that, again, this is not financial advice. I'm just saying you could take the free money you're able to get and put it into real assets, because this is what these large corporations are doing. They're buying back their stocks, which is real assets, and buying real estate, again, which is real assets, or buying things like gold, which is real assets, or Bitcoin, which is real assets. And it's just crazy. It took basically 2 years from the peak in 2000 to, or over 2 years, I'm sorry, to get to the bottom. Again, over almost a year and a half, or over a year and a half, basically here, from the housing bubble to get to the bottom, or get to, I shouldn't say the bottom, because nobody knows the bottom until after the bottom passes. So to get to half, all right, to lose 50% of its value. Here we see 30% of the value of the S&P. That's what I'm showing you here. If you're listening on the audio, it's 30% of the value lost within a month. So that's just crazy, man. It's just nuts. I'm going to play a video here on Twitter that explains what the Federal Reserve is. And I'm going to play this video.
About the Fed?
No, what about the Fed?
They announced another round of the quantitative easing.
What does that mean?
It means they are going to make large asset purchases via PAMO.
What does that mean?
It means they are going to expand their balance sheet and buy treasuries.
What does that mean?
It means they are going to print a ton of money.
So why do they call it the quantitative easing? Why don't they just call it the printing money?
Because the printing money is the last refuge of failed economic empires and banana republics, and the Fed doesn't want to admit this is their only idea.
So why do they want to print the money?
Because they say we have the deflation, and the deflation is very bad.
What is the deflation?
The deflation is when prices of the things we buy go down.
Isn't that good? Doesn't it mean the people can buy more of the stuff?
Yes, but the Fed said this is bad, especially during the recession.
So they think that during the recession, when the people have less money to buy the stuff, it is bad that the prices go down?
Yes, the Fed would rather have the inflation.
So why does the Fed think we have the deflation?
Because the CPI said so.
But aren't the food prices higher than a year ago?
Yes.
Aren't the gas prices higher than a year ago?
Yes.
Aren't the healthcare costs higher than a year ago?
Yes.
Aren't tuition prices higher than a year ago?
Yes.
Aren't the taxes higher than a year ago?
Yes.
Aren't the subway fares higher than a year ago?
Yes.
Aren't the stock prices higher than a year ago?
Yes.
Aren't the bond prices higher than a year ago?
Yes.
So what is deflating right now?
The only thing deflating that I can see is the Fed's credibility.
Did they have a lot of credibility to start with?
No.
Why not?
Because the Fed has been wrong about every major economic development in the past 20 years.
You mean they didn't see the internet stock bubble?
No. In fact, they helped fuel the internet stock bubble.
And they didn't see the housing bubble?
No, in fact, they helped cause the housing bubble.
And they didn't see the subprime crisis?
No, in fact, they told us subprime problems were contained right before the shit hit the fan and the Lehman went bankrupt.
So has the Fed ever been right about anything?
Let me see if I can think of anything. Nope.
So a cool little video there, animated video explaining how the Federal Reserve works. It's basically everything I spoke about. And if you give me a follow here on Twitter, you'll see that I retweeted it and liked this video, so you can share it as well with everyone that you know. So that's it, folks. We see that the Federal Reserve is going to not only have they cut rates. I even forgot to go over this part. Not only did they cut rates, right, all the way down to zero, but they're going to start the quantitative easing again, and that means they're going to pump $700 billion into the system, and they already pumped $420 billion into the system, or actually 400, actually over that. Oh my goodness, because the 420 plus the 75, so 495 billion into the systems from September, and now they're going to pump another 700 billion into the system, and interest rates are at zero. They have nothing left to do but to make interest rates go below zero, which is a negative interest rates. Japan already have negative interest rates. I think Sweden or one of the couple of the Nordic countries have negative interest rates, and other countries in Europe have negative interest rates. So the only play left is to have negative interest rates. The only people that benefit from having negative interest rates, or entities that benefit from having negative interest rates, are the banks, because they're charging the common folk money to hold. I mean, charging you a fee to hold your own money in the bank. That's what it comes down to. So this is one of my longer videos. Yes, I definitely want you guys to give it a like, share this video, leave your thoughts and ideas in the comment section below. Let's discuss it. Another thing I forgot to mention as well was the fact that Bitcoin pumped once this news came out that they were cutting rates down to zero. I mean, it's since dropped, but it did pump. And although Bitcoin took a lot off the top since this whole boo-boo crisis started last week, I shouldn't say it started last week, but this whole financial debacle started last week, and we saw everything from stocks to cryptos to everything is basically losing value. Gold, everything, all precious metals, everything is losing value at the current moment. But that's because people want to get their hands on cash. All right, and that's it for a video for another time. As always, thanks for watching. Please smash up the likes, hit that subscribe button, share this video, and then let's discuss it more in the comment section below. And if you're listening to the audio podcast, please leave a 5-star review and share this podcast. It's your boy, Sergeant Crypto, and I'm out. Peace.